If you're an IRA investor, traditional 401k investor, and you're considering a Roth conversion, but can't make sense of the taxes, you'll want to watch this video. This is a new strategy that we're using in 2026. It's not meant for everybody, but you'll want to take a look at it and see if it might work for your situation. Hi, I'm Mike Wright with Foresight Wealth Advisory here in Indianapolis, Indiana. We're a registered investment advisor for the state of Indiana. I'm going to share my screen and hop right to what we think is a very good way to help people convert their traditional IRAs into Roth IRAs. This is from a seminar we did earlier this month called Solving the Retirement Puzzle, putting together the pieces of an ideal retirement plan. This is just a short um, piece of the seminar. It was Roth conversions, tax policy considerations after the One Big Beautiful Bill. Basically, for Roth conversions in general, you can hedge against future tax policy changes. The federal tax rates remain subject to congressional action. These are the lowest taxes we've seen in quite some time, and with the deficits rising and inflation rising, we don't know how long these tax rates are going to last. So Roth conversions can help reduce exposure to potential future tax increases or rule changes. So today we know the rates, and the future, the rates are unknown. Conversions allow taxes to be paid at today's known rates, providing flexibility if future tax policy becomes less favorable. So if you convert your Roth now or over a series of, the next few years, um, you'll have it in a Roth IRA where it really doesn't matter if that's the most of your retirement income for your retirement account. Um, it won't matter what tax rates go up to, then go high, and you still have you'll have be able to get the income out tax free. Things you want to consider is the income and deduction interactions because conversions increase taxable income. They may reduce or eliminate certain deductions, credits, or benefits. So planning the timing and size of conversions is critical. Our note is to add tax credits. We're not actually, in this example, we're showing you a bonus depreciation investment that pays off the taxes, basically. So interaction with Social Security and Medicare, Roth withdrawals are tax-free and excluded from Social Security taxation. But if you do a Roth conversion, that can increase your provisional income, and Medicare earn much surcharges in the year of the conversion. So here, for the moment you've been waiting for, just kidding. In this case, we had a gentleman, married gentleman. He had a little bit over $1.5 million, and originally it was in his 401k. We rolled that into a traditional IRA. Initially, we were considering two or three traditional IRAs, but once we found this strategy, we rolled it into one traditional IRA. The biggest note, this is a case study example. Every Roth conversion, every tax strategy, every investment uh, proposal is specific to your situation. What is good for this gentleman may not be good for you. The taxes that he would have incurred, well, actually, he does incur these. If he were to take the 1.5 million, convert it all to a Roth in 2026 for U.S. taxes and Indiana state taxes, Indianapolis, which would be Marion County taxes, the total is $575,550. Initially, the taxes on the conversion were to be paid from an outside account. So he was not using money from his IRA to pay the taxes. And again, you want to do a thorough analysis of your situation because coming from your IRA versus having 600 grand in a outside account that's already taxed, that can change whether or not this makes sense for you. So in this case, the client was able to invest $167,500 into an investment that got him a tax deduction of $655,000. With that investment, he is expected to receive $3,000 in monthly cash flow, estimated for 9 to 10 years. Um, Again, this investment, it's a private investment. This client was a small business owner. He's familiar and has owned real estate. He's familiar with similar type of investments. He had to do these type of investments through his business. Um, so for him, this was not this was not a big deal to invest in this because it was, once you pay the 167,000, it's totally illiquid because you're getting the tax deduction. So he was able to get a total deduction of $655,000 in federal taxes. That reduced his 2026 taxes even further than the amount that would be due on the IRA conversion. So, and for future, um, he was expected to take $95,000 a year taxable from his traditional IRA to give him about $75,000 in income. He will save $26,315 in annual taxes from converting this to a Roth, and that's another $260,000 savings over the next 10 years, and it preserves his IRA. So the taxes versus the cash out of pocket, it's a wash with the new cash flow. Other items in the OBBB that you want to be aware of, the Roth conversions remain very attractive. Roth, if you time that with, this says tax credits, you can use tax credits. We use a special bonus depreciation investment. But if you time that with conversions, you can pay your taxes. He originally was going to have 500,000, paid his taxes for 150. So very good deal on that. If you have a qualified small business stock, which is basically a C corp, let's say you start it this year and you sell it for $12 million. This is phased in. Let's say you sell it for $12 million 3 years from now. You get 100% capital gain exclusion. 5 years from now, I believe it goes up to, it's either 30 million or 50 million. So if you're starting a new business and you're a founder, definitely consider a C corp because it may save you a boatload of money in taxes for retirement. Opportunity zone investments, they've been restructured to favor rural areas. So you get up to a 30% tax reduction investing in opportunity zones in rural areas. These really don't start up till January of 2017. Trump accounts is the next thing. They're tax deferred savings account for children. This is mainly for grandchildren or for charity. So investors and business owners, you have new tools, but only if you act while the rules are favorable. So basically, this is using bonus depreciation investment is a great way to get a tax deduction in the year that you convert your traditional IRA to a Roth. Generally, for most people, we say, if you don't have $1 million in your IRA, it probably isn't worth converting. That said, it really depends on your situation, how many outside assets you have. If you want to leave a legacy to your children, a Roth IRA will help you do that a lot easier than a traditional IRA. Or if you want to leave it to any other non-spouse. So I hope this video has been helpful. If you have any questions, feel free to contact us. The information will be below in the description. This has been Mike Wright with Foresight Wealth Advisory. Have a great day.